Hi, my name is George Adcock, and this is the 36 South end of Q2 market update, labeled Back to Square One. This year, we've been trying to put out a bit more content to help investors understand how we see the world and how and why they might want to position in different volatility assets. My role within the company, I am the head of trading and the deputy portfolio manager for our Kohinoor strategy. If there's anything that you see in today's presentation that you'd like to ask a question about, or you'd like a copy of the presentation, please use the email address in the description to get in contact with us, and we'll come back to you when we can. This presentation is going to be a slightly different format to the previous ones. We're going to spend a little bit of time going through some of the things that we've said in the previous presentation, and then going through what some of the kind of leading indicators, business cycle, what volatility is priced, and what that might mean for asset classes at the end. If you could take a quick second to read the disclosures, we'll get on with the presentation. If we look back to our previous presentations, the kind of core themes are on your screen right now. At the start of the year, one of the things that we noticed was that there was like very, very high expectations embedded into asset prices. And this was against a kind of slightly waning liquidity dynamic with kind of relatively tight policy and slowing cyclical economy. And we sort of thought that the underbelly for like quite a kind of rough period for assets and a relatively good period for volatility would be in place, and that was kind of the conclusion of our kind of start of year video. And then when we came through to Q1, which was recorded around Liberation Day, what we had started to see is that the market had moved from like very high growth expectations more towards where we thought the growth expectations were given the kind of cyclical dynamics in the economy. And we were starting to see certain trends like a slowing US consumer, a kind of growth peak that was looking like it was behind us, and kind of lackluster activity in sort of the commodities and industrial sector. And generally, what we had historically seen was that when this transpired, we would usually see equity momentum start to die. And we measured this by the kind of monthly MACD of kind of the all market equity indices. And what's been very interesting is since that video, we've had a phenomenon that's only actually happened once before in 30 years, where the momentum turned negative and has actually reversed backwards to the upside. And the last case that time that happened was in 1998. And in that case, we had a kind of surge in momentum followed by a kind of another corrective phase afterwards. It's unclear if that's kind of the path forward for risk assets today, but I'll take you through some of the things that we see in this presentation, and you can kind of make your own conclusion. And the final part was we thought that there was potentially an opportunity lining in the Swiss franc coming into kind of over like a medium longer term. It's been very interesting to watch in foreign exchange, where we've seen a kind of quite large deviation from where interest rate pricing is, well, real rate pricing is, to kind of where FX assets are today. And there's been a quite large flow story about the end of US exceptionalism, which has kind of taken hold of this kind of like relatively like dollar bearish narrative. And we've got a few points to touch on kind of in foreign exchange later in the presentation. If we look at kind of where we were at the start of the year, where we kind of were at the kind of the last video, and where we are now, I think this is like a relatively good chart for doing so. And this is the chart of Polymarket's recession odds for 2025. And you can see that we came into the year with very low recession odds, and through the kind of elevated uncertainty to do with tariffs and some of the Trump policies, we got all the way up to 65%, which was probably a little bit ahead of where the market should have been. And that uncertainty has really come back out of the market. And the reason why the presentation is called Back to Step One is we're kind of back to where we were at the start of the year, and we need to ask the questions of, has anything changed since then? Another good way of looking at this is through kind of Bank of America's fund manager survey. So every month, Bank of America sends out a survey to a large number of fund managers around the world, and they report what they are thinking and how exposed they are to different assets. And one of the things that we had noticed at the start of the year is that, the amount of people who are overweight cash had fallen to kind of like near record lows. And on the chart in front of you, you can see the cash allocation from fund managers. And what's been interesting is now actually after this kind of resurgent move in risk, actually the kind of fund manager cash position is the lowest it's been since kind of the equity kind of bonanza top from kind of unprofitable tech in 2021. And, the reason why this is important is it's important to understand if investors have more cash to put to work, which can then support the future prices of assets. And on a historical basis, we're now getting to a point where investors are very low on cash on an equivalent level over the kind of the last 10-year look back, and that kind of signals like a very positive view on asset markets. And we kind of think that there's a number of things happening under the surface which might question whether that's maybe the right position to be taking, and maybe having a higher cash level might be kind of quite a smart thing to do today. So one thing that's changed this year, which has been interesting to watch, and we've talked about this actually in the last two videos, was in the prior years, 2023 and 2024, once we started to see weakness appear in the data, what you would see is that the market would be very quick to price in kind of interest rate cuts. And the chart in front of you shows the differential between the federal funds rate and the 2-year US Treasury. And on the bottom is that differential. And what's been interesting is, like, even as weakness has kind of manifested, especially in some of the hard data more recently, largely due to kind of inflation concerns and how the Fed can react to them, the market has really been unable to price in further easing. And the effect of that is, whilst there's not a large amount of inflation in the system right now, and people are expecting it to come in the future, that actually makes policy relatively tight today. And every day that goes past, that works against those who are exposed to kind of higher interest rates or tighter policy. Now, one of the key things that's happened through this year is that there's been a very large divergence in inflation expectations, largely driven by kind of tariff-related policies. Now, the chart in front of you looks at basically the one-year inflation swaps between the UK, the European Union, and the US since Trump came into power, or actually since he won the election, I should say, sorry. And what you've seen is that there's been a very large divergence once the kind of tariff policies got going. Now, traditionally, what you would see is that, like, as economic weakness or perceived economic weakness manifests, generally you would expect lower inflation moving forward. Now, even when we had kind of peak kind of economic uncertainty and weakness in asset prices in April, we actually had surging inflation expectations, and inflation expectations are getting back up towards those high level today. Now, the effect of this, driven through effectively real rates, is that it has pushed like US real rates against the rest of the world down quite meaningfully. And in doing so, it's created a kind of a tailwind for kind of a short dollar trade. And we've seen that kind of manifest into, let's say, a rhetoric in the market that kind of this US exceptionalism is over, and that the dollar doesn't generally react to kind of weakness in the equity market. And, we'll be kind of quite careful about using that narrative of, for us, there are very sustained economic linkages that exist within the global economy, and we are a global economy. And if weaknesses were to persist for long enough, it's nearly certain that these inflation lines would start to correlate again. And in that case, you would have a situation where the market had positioned itself, very heavily on these diverging, and actually once they start converging, the market might find it's quite poorly positioned if the current rates dynamics were still in play. This is another chart that we have kind of taken from the last couple of presentations. And what it does is it measures how many countries have what are called leading economic indicators that are rising. And then it also tries to capture if that is accelerating relative to the previous trend. And for nearly kind of 6 months now, we've been in this kind of stasis where that number is kind of going sideways. But historically, once we get up to these levels and once momentum starts coming out of the kind of lower chart, which is the accelerating the number of them that are actually growing, so they're not just being positive and going up, but they're accelerating, it starts to roll over. What it does is it tends to suggest that the momentum is coming out of those leading economic indicators, and medium term ahead of us, you would expect the business cycle to decline. And we've seen kind of a few episodes of that from kind of 2013, kind of, let's say, 14 to 2016, quite sharply in 2018, again in 2022. And these are generally like kind of tougher periods to own assets, because expectations have to fall to where these leading economic indicators kind of suggest we're moving to. When we put those things together, what we've seen is that earnings in general have held up pretty well. There's a very very large spend going on into the kind of artificial intelligence space. Generally, like the consumer, although we believe weakening, is still spending. But what you'll see in front of you, and this is basically looks at the blended 12-month forward earnings per shares versus the previous 12 months, is that there tends to be some level of economic momentum that occurs within these earning per share things. And though that's starting to work against that earning per share kind of situation through time, and that's despite kind of asset prices being kind of back up to the highs. A lot of that involves actually kind of like multiples expanding, and what you want to see is you want to see this kind of orange line kind of roll back up, and it's quite a good barometer to be kind of long risk assets or not. Now, when you add those two kind of business cycle components together, what you see is that the growing leading economic indicator on the lower chart has quite a good correlation to when the earnings per share growth is going to go up and down on the top chart. And so, you know, when we think about this as kind of a business cycle of things going up and down, our expectation is over the kind of next kind of 18 to OECD diffusion to start to slide lower. And that's really going to pull people's expectations of EPS growth down. And if the market cannot continue to expand its multiples, you're going to have a re-rating in some assets. One of the other factors of things that have happened during kind of the Trump presidency is that the level of uncertainty has prevented CEOs from effectively making capital expenditure decisions. And in doing so, the kind of forward-looking spend out of the US corporate sector, despite some like very large fiscal packages and fiscal spend in certain kind of sectors, at an aggregate, CEOs are generally reporting kind of a reluctance to spend. Now, one of the reasons why this is quite important is that in the last few years, there's been a dynamic where corporates have effectively held on and hoarded labor in the face of economic weakness for fear of not being able to find replacement staff. And we'll show you kind of after this, but there's many signs that the labor market is now facing some kind of tougher cyclical dynamics. And when you add in the idea that, a CEO may not be looking to spend forward until some of this uncertainty is removed, what it does is it starts to kind of make that extra headcount look, very, very expensive going forward. And, the chart in front of you effectively is a Bloomberg aggregate of like a number of Fed surveys. And you can see that there's, a cyclical element to this, but coming into the year, we had this very big surge in capex intentions. People were like very, very positive on the Trump presidency, and that's really rolled over. And we're actually kind of at the lowest levels that we've seen kind of outside a recession at the start of this year. If we put the business cycle aside for a sec and look at some of the kind of like industrial market pricing, just to try and work out, is there any kind of pressure underneath commodities? Is some of the rhetoric that we see about kind of manufacturing or things like that, is it kind of, does it have some legs? What I've done is I create kind of an energy industrial cycle barometer and a metals industrial cycle barometer out of the kind of raw commodity prices. And there's been a lot of distortions in commodities due to tariffs and a relatively weak dollar. But this is like a very nice way of just trying to gauge if there's kind of pressure in the system. And what you can see is in general, in both series, we've kind of continued to kind of chop sideways. And that suggests that the kind of US ISM, which I put below, the kind of manufacturing survey, should stay relatively benign. We also see kind of relatively similar pricing in the equity market. So what the charts in front of you do is they take different sectors of the commodity equity landscape and they compare that to kind of the equal weighted S&P. And you can see that, whilst they have kind of somewhat based in 2025, with the exception of energy, there's no real positive momentum in these assets. And, to think about like an industrial pickup or a commodity driven kind of move higher in risk, you would really want to see kind of people start to allocate capital to these trades. And we just don't really see it yet. We're also very vigilant about what's going on in China. China has been the largest commodity consumer for a very, very long time. And one of the assets that's used at the kind of very leading edge of kind of like commodity rebar is effectively a steel that you put inside cement to strengthen it. You might have seen large buildings where it looks like it's kind of made of kind of steel straws. That is rebar. And rebar tends to give you a pretty good indication of where we are in the commodity cycle, whether there's excess demand about to happen, and there's subsequent demand that happens once rebar starts to rise. Now, the chart in front of you is the kind of Chinese rebar market. And what I've done is I've rebased it into G10 currencies to take the currency effect out. And you can see that despite being in like a pretty protracted kind of bear market since 2022, just prior to when commodities topped, you can see that, we're consistently making new lows. And really, we don't see any kind of momentum signal, which kind of suggests that a big commodity turnaround is around the corner, and that the industrial cycle has turned kind of like meaningfully up, meaning that the prices will rise. Compared to what we've seen in kind of the 2016 to 18 period and the post-COVID into 2022 period. Something that I mentioned earlier a couple of slides ago was that there's very large tariff distortions in many of the commodity markets, especially kind of the US futures markets. Prior to working at 36 South, I used to trade copper arbitrage between the LME and COMEX, which is a market that has really kind of like exploded recently as President Trump has threatened to put, a series of tariffs on US copper relative to the rest of the world. And that has led to, a lot of copper moving from the rest of the world into the US. Now, one of the effects of this is that if you look at, commodity indices that have high weighting to US futures, you generally see a kind of momentum that is slightly false, driven by the kind of tariffs. So what I've done to try and kind of illustrate this point and simplify this, I've taken an average of 4 of the leading commodity indices, which have like slightly different weightings to them. And then what I've done is I've taken the effect of the dollar out of the charts, and I've just put them in kind of vanilla currencies. So it's equal weighted G10 again. And it gives you a much better barometer of kind of like our commodities going up and down. And as you can see, we had like a very big kind of like emerging bull market from 99 to 08, which was the kind of China cycle, followed by kind of a year of sideways. And then after 2020, we had this like immensely, powerful and potent rise in commodity prices, which led to this kind of very large goods inflation spike. And since then, we really are kind of chopping sideways. And if you were to look at the chart and kind of zoom in for 2025, you can actually see that like once you account for all of these things, commodities are once again, relatively low in price. And we don't really see the momentum that we would be looking for in a kind of industrial cycle upturn. So when we kind of triangulate the idea that we still expect the kind of business cycle to be relatively benign from where we are outside a number of certain industries, we also see an industrial cycle that doesn't show any material signs of turning up today. When we add to that picture that we had at the start of the interest rate markets that were going to likely be a little bit too tight for the economy today, one of the things that you should start to see is kind of weakness in the labor market, especially given some of the other charts that we saw earlier showing that, CapEx intentions from CEOs had fallen quite materially. So the chart in front of you is actually like a very good long dated series just to show kind of how some of these dynamics work. And there's a place called the Conference Board, and the Conference Board basically do a survey, and the survey is, jobs hard to get or a jobs easy to get. And the blue line is effectively the differential. So jobs hard to get would be higher and jobs easy to get would be lower. And then the kind of gray line next to it is the U3 unemployment rate, which is kind of the standard unemployment rate that most people focus on in America. Now, in recent years, we've seen like a bit of a divergence between these measures. And as you can see that there's been a very good correlation going back to the 1970s between them. I think the things to take away here is that, the incentives for labor hoarding have fallen quite materially. I'm going to show you some other data afterwards, which is showing that, finally the labor market actually seems to be cooling quite materially. and that the series and like the kind of direction of travel for the conference board data continues to point to kind of further weakness. It's not that it's stabilized and that this is a period of divergence that's going to maintain. This is something that consistently is saying that jobs are harder to get. And we'll go through a few bits of data that I think triangulate that as a general view that the labour market in America is starting to weaken and potentially weaken quite materially. One of the areas that obviously people focus on is the kind of payroll growth at non-farm payrolls in America. And what we've seen kind of in recent years is that education and healthcare have been taking a large kind of slice of the pie, and they aren't necessarily what you would look for the private economy to be particularly strong. So what I've done here is I've isolated the private payrolls from the non-farm payroll, and then I've kind of adjusted that for the working age population. So if the working age population goes up, you have to adjust for the number of payrolls you should expect at any one point in time. And what you can see is that there is a kind of general slowing of momentum through time regardless. And then I've taken the 6-month average of those numbers. And really today we are kind of, with the exception of like a little bit last year, we're kind of at the lowest private payroll growth, like kind of 6 months at 5.1 basis points, really since kind of 2006. Most of the time we are below the level we are today is in these red sections, which kind of are the NBER recessions. So, the momentum in that private sector labour force seems to triangulate quite well to the idea of there being, a kind of end to this labour hoarding. And we see that kind of in the private payrolls and what the CEOs are saying. When we then think about what that means within the market, wages are the kind of derivative of what should happen in jobs, and then wages obviously feed through to inflation. And the chart in front of you effectively shows different points of the US interest rate market. So the top one is the Fed funds, the kind of the overnight rate. The middle one is the 2-year treasury, and the bottom one is the 10-year treasury, versus the rise in what's called the employment cost index, which is a kind of private sector way of looking at wages. Now, you can see actually for the first time since 2007, because the bars are positive, it's actually telling you that interest rates across the whole curve are now higher than wages. Now, that doesn't mean anything on its own, but what it does indicate is actually like that's actually like quite a tight position for the economy. It makes it harder for the economy to expand. And if you look back to the previous two instances where we've had this, these were both precursors to the kind of the tech bust and the GFC, despite it taking some time to obviously go through the system. For us to then think about, what are the things that may drive wages? One of them is obviously, as we mentioned, this supply and demand imbalance between labor and jobs. Now, one of the things we saw in the kind of post-pandemic world was this huge surge in job listings. And that really has like been sliding relatively consistently since 2022 to today. And this takes 3 different measures of that. There's a firm called LinkUp, and they've got the top 10,000 employers number of job listings on the left. And you can see that we're kind of back to a pre-pandemic level. You've got in the middle LinkUp kind of total market, and we're also back to pre-pandemic levels. And then on the right, you've got the jobs website Indeed, which is a kind of indexed value. And what's been interesting, specifically if you look at the LinkUp data, when you actually look at the year-on-year numbers, which are in the bottom panel, you're starting to see the momentum roll over to the downside again. And if you kind of like squinted it from an angle, you can see that, that was actually quite correlated to, let's say, the excessive risk-taking behavior where we, topped out in 21, we kind of slid down quite aggressively to 2023. And been kind of a slow roll up to 2025, and now we're rolling over again. Interestingly, that's not what we see in market pricing today, and we will come back to maybe why that may be happening at the end of this presentation. The effect of which, if there's less jobs for kind of like the workers out there, what happens is that the wage growth you get for switching jobs starts to decline. So when you have like a very, very hot job market, you feel very, very open-minded about changing jobs because you get a very large tick up in wages. And this series in front of you is effectively the difference in the wage growth for job switchers, regular employees, by the Atlanta Fed. And what you can see is that we're now at 0% gain. And this really doesn't tend to occur outside of kind of like very low growth recessionary periods, but is really kind of adding to this evidence that the labor market is actually quite loose, and you're not getting any pickup for changing jobs anymore. And if anything, we continue to see a kind of pattern of people slowly kind of losing jobs, and slowly kind of employers being less interested if we triangulate it back to the jobs growth. And obviously, this has a very large feeding into kind of confidence and what it means for inflation. Just to ensure that the Atlanta Fed data isn't looking at it from kind of like one direction, what I've done is I've taken a broad number of wage measures that are used in the market. On the left, we've got the hourly average earnings from the Bureau of Labor Statistics. We've got the Indeed wage tracker in the middle, and we've got the employment cost index on the right. And what you can see is that, effectively, these wage growth now has rolled back over in 2025 and is very, very close, if not under, the 1-year inflation swap. So once you start to factor, which is marked by the dotted line, once you start to factor like taxes and things like that in there, it's going to put like a lot of pressure on consumers in terms of like what they can spend and where they can spend their money. And it really makes kind of inflation like a very large burden in your economy if you're earning less than where the inflation expectations are within the system. One of the first places that you should start to see this turn up is in kind of the rental market. One of the largest places that people will spend their income is rents. And what I've done here is I've taken the Zillow data for different types of rental and compared them to the period from 2016 to 2019, and then just having a look at what they're doing kind of on a year-on-year basis. So the dotted lines are the 2016, 2019 averages. And you can see now that we're, well below all of those numbers. And that was a period that was consistent with, like more tempered services inflation than we'd seen more recently. But the other part that's like becoming very interesting is we had this like, very steep period of disinflation from 22 to 2003, the middle of 2023, which was being quite stable. And now that's started to roll over again. And that's very indicative of, wage pressure in the system. And that's going to create, a natural disinflationary pressure on the service sector inflation. And we can see that by looking, what that trend has been. So when we look at kind of CPI, owner's equivalent rent, which has been one of the very sticky things in the inflation bucket, and shelter, which kind of captures things more broadly on the right, you can see that all things being equal, we should probably trend back to where that 2016, 2019 average is. And that's going to put kind of like quite, disinflationary pressure on the shelter component of the CPI bucket, which will in some ways act to offset the kind of inflationary side of the tariffs on the good side. And so, whereas the market thinks there may be quite a one-way bet on inflation, when you look at kind of where the inflation swap pricing is, this is going to act as like quite a big drag on that going forward. The other thing that we would kind of expect to see if labor markets were slowing down is we would expect to see kind of real consumption and real expenditure drop. And the Bureau of Labor Statistics produces a real personal consumption expenditures index. And despite the chart on the left being a little bit choppy, what it does is it takes the growth it's just 6 months annualized of the numbers and takes the growth of that. And actually, if you add in today's numbers, which haven't been released, but you triangulate them, we're actually at zero growth today, which is more consistent with a like a much slower economy. Maybe like a simpler way to think about it is if you look at the kind of 45-degree line we've got on the right hand chart, we haven't really got any higher than we were in December, which is the kind of this area on the chart. And that shows like a really large slowdown in personal like expenditures, and this bars represent what the last 6 months has been. And you can see that this is a significant drop off from what we've seen more recently. This is like a significant drop off from what we've experienced more recently. One of the reasons why this is like quite important is one of the things that has driven this cycle hasn't been so much credit growth, but has more been kind of income growth. It's been an income driven expansion. And there are signs now that that income driven expansion is actually under threat to some extent. If we add together what we see in the business cycle, what we see in the industrial cycle, and what we see kind of in the labor market, they all triangulate to a economy that is relatively is slowing, is relatively slow, and where the most important bit of the economy, which is labor and people's ability to earn wages, is starting to fall relative to what we've become used to. And that's going to be a more challenging outlook to sustain asset prices where we have. The final one that I've put in here just on wages, and there may be some effect from the kind of clampdown in immigration here, but the TSA is effectively the travel checkpoints in America for people moving around. And what you've seen is that, where we had like very, very high growth, people had a lot of income, they wanted to travel more, has been like very, very high. We're effectively down to kind of like negligible, very low single figure growth. Most of the growth has come out of people wanting to spend money on vacations and that sort of thing. And I appreciate there's a two-tier economy, and there's definitely still some people spending. But when you look at it in aggregate, you see the kind of same trend, which is like a quite material slowdowns. If you add up, rents, the personal consumption expenditure, and travel, they all kind of suggest a relatively similar outlook, which is a quite material slowing on the kind of labor side in the private economy. What's interesting is obviously market pricing doesn't, I wouldn't say, particularly reflect that. And what we really see is kind of a two-tier economy. And I thought this was quite a good way of illustrating it. In some of the previous videos, we published a cyclical index, which took an aggregate of home builders, semiconductors, and industrials, which have been a good lead of the cycles more recently, and showed kind of that we'd had some kind of cyclical weakness. And now what we're actually starting to see is like quite large divergence within that bucket itself, where semiconductors relative to like beta, so like versus S&P or equal weight S&P, like you see on the right here, are actually starting to turn up and become more positive, suggesting a kind of upwards business cycle. And on the left, you've got the home builders, which are reflecting a dynamic where the consumers are becoming, despite being resilient in some matters, are kind of tapped out of cash relative to where rates are today. And we've started to see quite large builds in unsold housing inventory, new housing inventory, and all of those things will feed back into the rent dynamic that we talked about earlier. And this is where it becomes, a relatively interesting economy, where the economy that is being affected by some of the fiscal expenditure and fiscal expansion is doing relatively well. And the bits that are kind of, I would say, affecting your everyday person are slowing down. And what that means in aggregate is that the public sector is now having to do more of the heavy lifting in the economy relative to the private sector. So that very much feeds into the deficit conversations that people are having. It feeds into kind of the employment outlook. If you think back to what Scott Bessent was saying at the start of the year, it was, we want to reduce the number of government employees, put them into private sector jobs where they could be more productive. What's going on inside the market and what we see in the data suggests that, that's probably not the direction of travel of what's actually going on. And that creates kind of a relatively interesting market. We also want to try and understand, why is it that despite identifying that hard data and cyclical forces were going to weigh on the economy in aggregate, asset prices haven't really reflected that. And really, in reality, we're all here to trade asset prices and not kind of look at kind of economic cycles. And the big factor here has really been that there has been a gargantuan surge in liquidity coming from a variety of sources, and we can go through those now. So this is a liquidity indicator that I have built. The inputs generally close to like a financial conditions index. It uses the dollar, oil, and rates. And if you think about this year, we've had this kind of triple whammy of relatively stable rates plus a dollar that's falling and oil that's falling. And traditionally those two assets would be kind of correlated the other way. And that has given the average consumer like a bit of an easing relative to where we were before, and asset prices have reflected that. We also have seen liquidity kind of surging from a policy perspective. Now, we had seen quite a large portion of the world's central banks cutting interest rates over the last couple of years. We had seen the Fed was largely on hold, but the Treasury, through kind of its issuance calendar, had been injecting liquidity into the system. But the really big story here is actually what's going on in China. What's starting to happen in China is like very, very interesting. So if we go back to some of the linkages that we talked about prior, we had a situation where you've got unilaterally expanding inflation swaps in the US, which is driving a lot of real rate pressure against the dollar. And some of the rhetoric from the campaign is asking people to generally kind of question this US exceptionalism. And that has created a kind of a bid for non-dollar assets. And despite the inflows into US assets being the largest ever, you don't actually need to move that much money to move the needle in some of these other kind of markets like Europe. As that's happened, and the tariffs have been laid onto America very strongly, the Chinese have actually opted to effectively almost like repeg the Chinese yuan to the dollar, and not allow the yuan to strengthen. And whilst that there has always been a kind of soft peg, or a kind of a soft exposure, actually generally the yuan has shown some kind of strengthening and weakening bias relative to dollars anyway. So if you look at the data in front of you, you can see the liquidity injections coming from the People's Bank of China, from cross-border capital. And the minute the dollar really started to decline, the PBOC have like really stepped their foot on the gas, effectively adding Chinese yuan to the system. Now, the effect of which, when you add in two very large capital markets that you no longer are putting capital into, is that you've now got the dollar is for sale and CNH is for sale. And the effect has really been to squeeze the currencies that aren't in those buckets, and there aren't enough big ones to do it really. And that has been like very positive for the European currency, added to this idea of kind of a fiscal package that has kind of changed some of the debt dynamics in Europe. Of you, so the kind of G10 indexes, so this is each currency versus G10, and you can see that there's kind of like a pegging competitive devaluation now going on between the US and China. And a lot of the rhetoric out of the administration has been that they are in a very large geo-competitive landscape. And whilst this is going on, it's going to force assets to do quite generally put upward pressure on assets, while both are trying to add liquidity to the system at the same time. Now, on the flip side, if we put our kind of tail risk invest hat on and try and understand, like what are the risks to that trade? Obviously, one of the major things is that debasement and risk assets kind of investments have done really, really well recently. Now, if you just take the charts in front of you, you've got high yield credit spreads in the US for the last 3 years. You've got the German DAX and you've got the S&P. Most of those are pretty much at their best levels in the last 3 years. And then on the bottom, you can see that the euro has traded very well this year. You've got JPM, EMFX index in the middle, and gold on the right-hand side. Now, obviously, some of this, the market move is really kind of like predicated on this liquidity picture continuing. However, when you kind of add all of the things together, what becomes quite interesting is that if we do get a kind of slower inflationary pressure than the market expects, because cyclical pressures are relatively negative in America, and there could be kind of a recorrelation with the rest of the world. It could be like relatively dollar supportive. Or we see a situation where this liquidity actually starts to turn back up some of the industrial parts of the economy. Not something that we've seen, and not something that we particularly expect right now. You could push the Fed into like a kind of tighter position, which is also going to create kind of like some support to the dollar markets. And should that happen, what's then going to happen is that you're going to get retrenchment from both kind of assets FCI perspective, as well as potentially the Chinese taking liquidity out at the same time. And that would be like a much, much tougher environment for assets in general. When we look at historically, when we've had these periods where over the medium term, our leading economic indicators have started to fall, in the last 14 years, that has generally been relatively positive for the dollar. So what I've done here is I've taken the periods where the diffusion index, kind of the dark blue line, is falling, and I've on the top chart, I've put the trade weighted dollar index, and you can see that when they've fallen, I've shaded it red. They have generally been more positive times for USD. Now, you could definitely look at this chart and say that the top of our leading economic indicators was in the middle of 2024. It's perfectly possible. We are at about the same levels of there in the dollar. But it generally suggests, like our forward-looking outlook, if the previous correlations were to hold, it could be more positive for the dollar than we've had more recently. And if that happens, we potentially walk into this scenario where liquidity could tighten quite quickly. And as shown on the previous chart, that could mean that asset prices look a little bit more vulnerable under the surface from that. If we then look at what's priced into kind of volatility markets, which is where 36 South operates, whilst volatility as a whole has generally been higher since April, but is slowly rebasing, you can see that there's some quite good value in the equity derivative markets from a kind of like volatility perspective. And I'll quickly explain how the grids in front of you work. So along the top, you've got the Euro Stocks, which is the kind of top 50 firms in Europe. You've got the FTSE 100, that's the top 100 in the UK, and the ASX on the right is Australia. And these may be slightly more minor markets compared to S&P. But the bit I want to draw your attention to is the vol percentile at the bottom. And these basically go back as far as we have data. So we are looking in the sort of maybe like 2010 period for these indices. And you can really see that, we are really down there in the vols, especially in things like FTSE. Now, they have a lower ownership profile than the S&P, but there's some pockets of value out there if you did think that there's a possible that the liquidity retrenchment could happen. The other thing that we would like to draw your attention to, and we have previously, is that due to higher interest rates, the equity forwards are in what we call a contango, where the spot market of S&P is below the forward markets. And the effect is that it makes your put option on the index, all things being equal, cheaper. And what I've done here is I've done like a linear Black-Scholes calculation for S&P 1 year 90% puts. And you can see that despite volatility that has risen, when you actually look at it on kind of like a pricing level, we're really in that kind of 2017, 2018 kind of trough when we compare it to where the index is. So there's still some pretty good value out there, especially if you're prepared to increase the duration of your hedging bucket in America. When we look across into like currency volatility, one of the things I've found kind of more surprising is, given the level of kind of like verbal rhetoric between America and China, that we have kind of dollar CNH, topside vol, in this case 1 year 25 delta, is really trading at kind of the lows of the last 10 years. Now, some of this is obviously the competitive devaluation / pegging forces that are happening in the market, pulling the kind of daily variance of that currency right down. But when you think about the potential of removing liquidity, if it should happen, the odds are that kind of pegging is not going to kind of happen quite as stringently as it's happening today. And that could actually put like quite a bit of pressure. And you're only ever really like one news flow or kind of like the feedback of economic tariffs from this potentially being like quite a lot higher. So, it potentially represents like quite good value within the volatility landscape. What if this doesn't happen, and it's perfectly possible that the liquidity train does keep going? It wouldn't necessarily fit with what we believe economically, but we have to be open-minded to all outcomes out there. And what we really see is that then, you generally want to look at kind of debasement type trades. And, the trades that have historically done quite well in that more recently has been kind of Bitcoin and gold. And when you look on the left-hand side, you've got gold versus bonds. If you look at the middle, you've got gold versus risk parity, and on the right hand side, you've got gold versus S&P. And what you can see is gradually gold is starting to outperform these assets as more and more liquidity is added to the system in a situation where potentially inflation expectations from the market are slightly less anchored, and there's a growing acceptance that this could be more of a debasement type move. I hope that you've really enjoyed the presentation. As I've said previously, we're trying to make more of the content to try and explain some of the things we see, some of the things we think. If you have any questions, you'd like to inquire about what 36 South does, or you'd like a hard copy of this presentation, please contact ir@36south.com. If you'd like to, please follow us on YouTube and LinkedIn, where we were posting the updates of new videos that we will make in due course. And we welcome any feedback. I hope you have a great day.